Okay, let's unpack this. You sent us a stack of material on a company that's gone through an absolutely massive transformation, rising to become, well, one of the most valuable businesses on the planet. Today, we're doing a deep dive into Microsoft Corporation.
Exactly. We've taken this comprehensive analysis you provided. It's full of reports, financial data, market insights, looking at their strategy, their position, potential risks, everything, with data right up to May 30th, 2025.
And our mission here is pretty simple. Cut through all that complexity, guide you straight to the most important insights, maybe uncover a few surprising facts along the way, and help you quickly understand what's really driving Microsoft today and, frankly, why it should matter to you and anyone following the tech world.
Let's jump right in then with the big picture. What really stands out from all this material is that Microsoft is, without question, a technology titan right now.
Absolutely. And the story here, it's that remarkable transformation under Satya Nadella. They really pivoted hard, didn't they? From being primarily focused on the PC, which was, their legacy identity, to dominating in cloud and increasingly in AI.
And that pivot is exactly why you see such resilience and continued growth capacity, even as the tech landscape keeps shifting so wildly. It's clear that their intelligent cloud segment isn't just big, it's the largest revenue generator and the fastest growing part of the whole business.
Which perfectly aligns with what their CEO, Nadella, has been saying about AI.
Yeah.
He doesn't just see it as another product feature, does he? He sees it more as a core engine that will transform, everything they do across all their business lines.
Mm-hmm.
You see this reflected in their strong financials, their rapid AI innovations like Copilot, and of course their leadership position with Azure in the cloud.
But as this material also clearly shows, that level of success doesn't come without its challenges. The environment is intensely competitive. Incredibly so. And there are substantial risks they have to navigate, especially around things like cybersecurity and increasing regulation.
Right. It's a complex beast, no doubt. But their stated ambition, their vision through all of this is to democratize access to this new generation of technology. That's a huge statement, really, about the role they see themselves playing in shaping the future.
Yeah, and speaking of their vision, it's actually really interesting to look at the evolution of their mission statement. It tells you a lot about their strategic direction. Back in 2013, it was all about enabling people and businesses to realize their full potential by creating technology.
Okay, so that was then. And where are they now?
Now it's to empower every person and every organization on the planet to achieve more. It's a distinct shift, you see. It's less focused just on their technology as the end goal,
right,
and more on empowering you, the user or the organization, to achieve your goals. It really reflects Satya Nadella's concept of the Agentic era, this idea where AI acts as an agent helping you accomplish things.
That subtle change in wording, it's actually quite powerful when you think about the implications. Okay, quick basics then. Founded in 1975, headquartered out in Redmond, Washington, they've got this massive global presence, over 100 countries. Core values listed are respect, integrity, and accountability.
And guiding this shift, of course, is Satya Nadella. He's chairman and CEO, been in the CEO role since 2014, taking over from Steve Ballmer. His history within the company is deep. He worked on key projects like Windows NT and led their cloud platform before stepping into the top job.
And the analysis gives him significant credit, rightly so it seems, for that fundamental reorientation towards cloud and mobile. He's also seen as instrumental in fostering key partnerships and cultivating what's described as a healthier corporate culture. And the numbers really back this up. The broader Microsoft Cloud business is now pulling in over $100 billion in annualized revenue, and Azure is clearly the primary engine behind that success.
Okay, so let's follow the money then. Let's look at the financials. The stock, trading on NASDAQ, ticker MSFT, had its IPO way back on March 13th, 1986, launched at $21 a share.
Wow, $21.
Yeah.
Compare that to May 30th, 2025, where the market cap is sitting around a staggering $3.42 trillion. Just incredible growth.
Yeah.
Their fiscal year, by the way, wraps up on June 30th.
And for investors, they pay a quarterly dividend, most recently $0.83 per share. And the material highlights a really significant return to shareholders, $9.7 billion in just Q3 of their fiscal 25 alone, through dividends and stock buybacks.
You see the usual suspects among the major shareholders, the big institutional players like Vanguard, BlackRock, State Street.
Yep.
And Bill Gates, the co-founder, still remains a significant individual shareholder.
Right. Now, looking at the revenue trends over the past few years, say fiscal 22 through 24 and the latest quarter, Q3 FY25, you see consistent, pretty impressive growth. Revenue went from $198 billion in FY22 to about $211.9 billion in FY23. That's around 7% growth. For FY24, the estimates range higher, somewhere around $245 to $261 billion, closer to 16% growth. Their trailing 12 months revenue as of March 31st, 2025, hit $270 billion.
And that Q3 FY25 specifically was $70.1 billion, a solid 13% increase year over year. Strong numbers.
But what's really insightful about those numbers, I think, is the shift in where that revenue is coming from. Servicing cloud revenues are just taking an increasingly larger slice of the pie.
How so?
Well, in FY22, services were $125.5 billion compared to $72.7 billion from products. Just 1 year later, FY23, services jumped to $147.2 billion, while products actually dropped slightly to $64.7 billion.
So that's not just revenue growth, it's a fundamental shift.
Exactly. It's a successful transition to a model based on recurring revenue, which generally provides better predictability and potentially higher profit margins over the long haul.
And the profitability seems to back that story up.
Yeah.
Net income climbed from $72.7 billion in FY22 to an estimated $92.75 billion in FY24. Q3 FY25's net income was $25.8 billion. That's up 18% year over year.
Right. And operating income saw similar strengths. It grew from $83 billion in FY22 to over $109 billion in FY24. And Q3 FY25 came in at $32 billion, up 16%.
Their diluted earnings per share, that's basically the net income spread across each outstanding share for Q3 FY25, was $3.46, also up 18%.
And it's pretty remarkable, isn't it, that they've achieved this kind of growth even while making, as the analysis notes, considerable investments in AI and cloud infrastructure.
Yeah, they're spending big.
They are. And this ties directly into Satya Nadella's stated strategic goal to manage the cost structure dynamically to generate durable long-term operating leverage. So they're investing heavily in the future, but still managing to grow the bottom line efficiently. Pretty impressive balancing act.
Let's take a quick snapshot of their balance sheet. As of March 31st, 2025, it shows their financial muscle. Total assets were $562.62 billion, with total stockholders' equity at $321.89 billion. Total debt was $60.56 billion, but that's offset by a healthy $79.62 billion in cash and short-term investments.
Yeah.
You can really see how both assets and equity have ballooned significantly over just the last few years.
And when you look at valuation, comparing Microsoft's trailing 12 months ratios, things like price to earnings, PE, which kind of tells you how much investors are willing to pay for each dollar of earnings.
Right.
Or price to sales, PS, and EBITDA, comparing those to peers like Apple, Alphabet, Amazon. Microsoft's ratios are generally above the industry average, which basically indicates the market has really high expectations for their future growth.
Makes sense.
Another key metric highlighted is their return on invested capital, ROIC, at 26.4%. That's compared against a weighted average cost of capital, WACC, of about 6.8%. Now, ROIC tells you how effectively they're using their capital to generate profits.
And WACC is what that capital costs them.
Exactly. So when ROIC is significantly higher than WACC like it is here, it's a strong indicator that they're creating real value for their shareholders.
Okay, so we've looked at the money side. Now let's dig into how they actually make that money. The analysis organizes this into what it calls their three main pillars or segments. And this structure itself has evolved, right? Down from 5 segments back in 2012, shows a strategic consolidation.
Right. First up, and arguably the most important, is intelligent cloud. The sources consistently call this the heart of Microsoft's strategy. It's their largest source of revenue and profit, and critically, their fastest growing engine.
This is where you find their big foundational cloud services like Microsoft Azure, plus things like SQL Server, Windows Server, GitHub, and various enterprise services. And the Q3 FY25 performance really tells the story. $26.8 billion in revenue, up 21% year over year. Impressive.
But the key insight here is the growth within that segment. Azure and their other cloud services grew even faster, up 33% year over year. That's 35% if you adjust for currency fluctuations.
Wow.
And the overall Microsoft cloud number, which is a broader measure that includes cloud services pulled from other segments too, hit $42.4 billion in the quarter, up 20%. Just massive scale and growth.
Its strategic role is obviously huge, especially for their whole AI push, right? It provides the essential plumbing, the infrastructure needed for training these huge AI models and running the AI services.
Exactly. They're building specialized hardware like the Azure Maya accelerators and partnering with key players like NVIDIA and AMD to bolster this. Even services like Azure Arc, which helps companies manage cloud services across different environments, not just Azure. That's seeing huge growth, up 90% year over year, hitting 36,000 customers.
Okay, pillar number 2.
That's productivity and business processes. This is where you find the stuff most people interact with daily. The Microsoft Office suite, including the cloud-based Microsoft 365 for both businesses and consumers.
Right, Word, Excel, Teams.
Yep. Plus Dynamics 365 for business applications, and also LinkedIn, the professional network.
And this segment contributed $29.9 billion in revenue in Q3 FY25, up 10% year over year. The growth seemed particularly strong in the cloud versions. M365 Commercial Cloud up 12%, Consumer Cloud up 10%, and Dynamics 365 up 16%.
Yeah, the core importance here is all about enabling how people work, communicate, collaborate. And again, AI is being woven deeply into this through Copilot, aiming to fundamentally change how we use these familiar tools to actually get things done.
Okay, and the third pillar?
The third pillar is more personal computing. This is a bit of a broader category. It includes Windows operating system licenses sold to PC manufacturers and businesses, their own Surface devices, the Xbox gaming business, and their search and news advertising business, which is primarily Bing.
This pillar generated $13.4 billion in Q3 FY25, showing a 6% increase year over year. And it's noteworthy because this segment actually returned to growth after seeing a decline in fiscal 23, right?
That's right. The growth in Q3 FY25 was driven by strong performance in a few areas. Xbox content and services were up 8%. Search and news advertising was up a really robust 21%. And Windows OEM licenses, that's licenses to PC makers, were up 3%.
And the Activision Blizzard acquisition, finalized back in October 2023, that obviously significantly boosts their gaming presence, gives them a huge library of content and communities.
Absolutely. And their recent announcement of Copilot Plus PCs shows how they're embedding AI right into the core Windows experience itself now.
So one of the key takeaways from this breakdown seems to be the powerful synergy between these segments. Is that fair?
Oh, absolutely. The Intelligent Cloud isn't just a standalone business. It's really the engine fueling the others. It provides the AI and data capabilities that are then integrated into things like M365 Copilot and these new Copilot Plus PCs.
So it's not accidental. It's a very deliberate strategy.
Completely deliberate. It aligns perfectly with Satya Nadella's Copilot stack. Vision this idea of building a unified layer of infrastructure, data, and AI that powers everything else they do. Those massive investments they're making in Azure AI infrastructure aren't just for Azure. They're long-term assets designed to benefit the entire company. Azure's strength is critical for enhancing products across all segments.
And the Activision Blizzard acquisition, you mentioned integration. That's a big test, isn't it? How well they can weave that gaming content and those communities into this broader ecosystem, maybe connecting it back to cloud gaming via Azure or even, future metaverse ambitions.
Exactly. That integration is a major strategic play to watch.
Okay, stepping back again to look at the playing field, Microsoft is operating in some incredibly dynamic and high-growth markets: cloud, productivity software, gaming. Seems like they're in the right places.
They really are. The cloud market in particular is a key growth driver. Now, the numbers vary a bit across the different sources we looked at, but they all paint a picture of just rapid expansion. In the U.S., the market was valued over $216 billion back in 2023, with projections showing over 20% annual growth right through 2030.
And software as a service, SaaS, makes up the largest chunk of that.
Yeah, SaaS dominates, but infrastructure as a service, IaaS, is also seeing really strong growth, around 20.9% CEGR.
And globally.
Globally, estimates for the cloud market size in 2024 range anywhere from $142 billion up to over $260 billion. Projections stretch way out to somewhere between $361 billion and $838 billion by 2029, 2034, depending on the source. That implies annual growth anywhere from 12% to 18%. North America holds a significant portion, over 42% in 2024.
What's driving all that growth?
It's a confluence of factors: the explosion of big data, the sheer demand for AI and machine learning capabilities, growing cybersecurity needs, the ongoing push for digital transformation across pretty much every industry,
Right.
and just the fundamental need for scalable and flexible computing solutions. The analysis notes that a huge percentage of companies, something like 85%, are expected to adopt a cloud-first strategy by 2025.
And Microsoft's position within that.
Their position with Azure is strong. They hold around 23% market share globally. That puts them solidly in second place behind Amazon's AWS, which has around 33%, but comfortably ahead of Google Cloud at 9-10%. And they continue to pour significant capital into this area, like that recent $3.57 billion investment in Germany that was mentioned.
Okay, what about the productivity software market?
Also expanding rapidly. Global market size estimates for 2024 range from $46 billion to $65 billion, projected to grow to somewhere between $90 billion and $200 billion by 2029-2032. That's annual growth rates between 13% and 16%. The U.S. market alone was $17 billion in 2023, expected to see 14% annual growth.
And the drivers here are things like remote work, automation.
Exactly. Remote and hybrid work models are huge drivers, plus the increasing need for automation, better collaboration tools, the general shift to cloud-based solutions, and now the integration of AI tools like Copilot to boost efficiency. And Microsoft just dominates this space with Windows and Microsoft 365. They reported over 300 million paid M365 subscribers way back in 2022, and it's certainly grown since then.
And finally, the video game industry, still growing strongly.
Oh yeah, sustained growth. Global market size estimates for 2023-2024 range from $230 billion up to $310 billion, with projections hitting $505 billion to $563 billion by 2030-2032. That implies annual growth between 8% and 13%.
What's fueling that? Online gaming, mobile.
Yep. Trends like online multiplayer gaming, the rollout of 5G connectivity, improving mobile gaming experiences, and the continued rise of esports. Microsoft's position here is significantly strengthened, as we said, by the Activision Blizzard acquisition and that strong 8% growth in Xbox content and services revenue last quarter. Their subscription service, Xbox Game Pass, is also a crucial piece of their strategy there.
So when you connect all these market dots, you see Microsoft is really benefiting from a powerful tailwind, right? Operating in multiple markets where double-digit growth is basically the norm.
Absolutely. And the synergy between them is key. Cloud gaming relies on cloud infrastructure, AI capabilities, enhanced productivity tools. What the analysis really highlights, though, is Azure's role as this critical enabler of innovation across all these markets. Well, if Azure becomes the default platform for AI development and deployment, which seems to be their goal, given the massive infrastructure investments, it could potentially create a whole new wave of platform lock-in. Kind of similar to what we saw with Windows decades ago, built on those powerful network effects and high switching costs.
Right. The more people build on it, the harder it is for anyone else to compete or for users to leave.
Precisely. If Azure becomes the standard for AI dev and deployment, that creates enormous leverage.
Okay, speaking of competition, let's look at who they're actually up against and what gives them their competitive edge, what some analysts call their economic moat.
It is an incredibly competitive environment. Fiercely competitive. Yeah. The sources list a really formidable lineup. Overall tech giants like Apple, Google, Amazon. Then you have enterprise players like Oracle, IBM, SAP, Salesforce, and more specific rivals too, AWS and Google Cloud, obviously, Sony and Nintendo in gaming, Red Hat in operating systems, and of course Google completely dominating search.
And the financial comparisons included in the analysis really highlight just how large and financially powerful some of these competitors are themselves. Apple, Google, Amazon, these are behemoths.
No kidding. So how does Microsoft hold its ground against all that? The analysis describes Microsoft as having a wide economic moat, and it references strong ratings backing this up from firms like GuruFocus and Morningstar.
What are the key components of that moat?
Well, there are several. A powerful global brand, for one. Massive network effects, think Windows and Office 365, which create really high switching costs for users and especially for businesses. Significant economies of scale from their global cloud infrastructure, extensive intellectual property built up over decades, and a highly diversified product portfolio, which gives them resilience.
What seems particularly emphasized in the material is their deep enterprise ecosystem and the high switching costs that creates.
Yes, exactly. They are fundamentally embedded in how large businesses run their IT operations, particularly with Azure, Dynamics 365, and Microsoft 365 all working together. This level of integration makes it incredibly difficult and costly for customers to just rip and replace them, especially with Azure supporting their core business workloads.
And their consistent, substantial investment in innovation and R&D, particularly focused now on AI and cloud, is obviously critical to maintaining that edge.
Absolutely.
Yeah.
But it's fascinating how they are actively working to deepen that moat even further. The analysis points directly to the synergistic integration of Azure, M365, Dynamics, and now AI via Copilot. This creates this comprehensive, interconnected ecosystem that competitors really struggle to replicate across the board.
So the whole is greater than the sum of its parts.
Precisely. That AI integration, powering Copilot across all their products and sitting right on top of Azure, creates this powerful flywheel effect. Customers using Azure for their AI projects are naturally more likely to adopt Microsoft's AI-enhanced applications, and vice versa. It just constantly increases those switching costs. While competitors might be strong in one particular area, they often lack Microsoft's unique breadth and that really tightly integrated offering.
And that fundamental shift they made to cloud subscription models for things like M365 and Azure, that's been huge for strengthening this moat too, hasn't it?
Oh, massively. It provides that stable, predictable, recurring revenue stream, which investors love. It increases customer dependency because services are constantly updated, and it allows them to rapidly deploy new features and crucial security updates, making those services much, much stickier than the old model of buying boxed software every few years.
Okay, so let's look ahead then. What does this analysis tell us about their strategic initiatives and the general outlook for growth?
Well, the strategy, driven clearly by Satya Nadella, is, as the analysis puts it, resolutely focused on artificial intelligence and cloud dominance. That's the headline.
Nadella's vision, as articulated in the material, seems to be that cloud and AI are the essential inputs for every business going forward. They see innovation happening across the entire tech stack, from infrastructure up to applications.
Right. And they're building what he calls the 3 key platforms for this emerging agentic era. Copilot as the new AI-powered user interface.
Okay.
The Copilot stack providing all the underlying infrastructure and services needed to build and run AI.
Right. The plumbing.
And a new category of Copilot devices, like those recently announced Copilot Plus PCs, designed specifically for AI workloads.
And there's a massive ongoing commitment to just expanding their global cloud and AI capacity, isn't there? New investments happening literally across 5 continents.
Yeah, the scale is huge. They're aiming to position themselves for growth for the next decade and beyond. Their R&D efforts are heavily concentrated in, you guessed it, productivity, intelligent cloud and edge computing, and personal computing, all with the overarching goal of helping customers actually leverage the benefits of AI.
The pace of recent developments, especially in late 2024 and into the first half of 2025, seems pretty intense. We saw the preview of SQL Server 2025 back in May, specifically positioned as an AI-ready enterprise database with integrated AI services and other enhanced features.
Yep, and their big developer conference, Microsoft Build 2025, also in May, had a whole slew of key announcements. Things like Copilot tuning starting to roll out for their large enterprise customers, new pro-code features being added to Copilot Studio for developers, a new protocol called A2A to help teams' agents communicate better, enhancements to Copilot pages.
Lots of Copilot stuff.
Loads of Copilot stuff. And something called Azure AI Foundry, described as an AI app and agent factory. Plus, updates to Microsoft Fabric for data analytics, like a digital twin service and chat with data features, and the general availability of SQL Server Management Studio 21, which is a key tool for database admins.
And there was that potentially very significant, though maybe more futuristic development back in February 2025, the unveiling of their first quantum chip powered by a topological core, Microsoft Majorana 1.
Right, that's a longer-term play, but potentially transformative. On the more immediate commercial side, they've been actively updating their cloud solution provider, or CSP program. That's how many smaller businesses buy Microsoft Cloud services. They extended discounts for M365 Copilot and introduced new 3-year contract terms for M365 enterprise plans offered via CSPs.
Okay, what about partnerships and acquisitions over the last year or so? Any key moves highlighted?
Well, the acquisition of Inflection AI in June 2024 was aimed squarely at strengthening their conversational AI capabilities, feeding into M365, Azure AI, and their OpenAI partnership. And of course, the massive Activision Blizzard acquisition, finalized in October 2023, is still in the process of integration, but fundamentally changes their position in the gaming world.
And that ongoing collaboration with OpenAI, that's just fundamental to their whole AI strategy, right? It powers both their own Copilot products and their Azure OpenAI service, which lets other businesses access those powerful OpenAI models directly through Azure.
Exactly. It's a cornerstone partnership. We also see Copilot evolving into a platform itself, with third parties like Box now integrating their services directly into M365 Copilot.
So looking at the analyst consensus and future projections, particularly out to fiscal year 2026, what's the general feeling?
Overwhelmingly positive based on this material. Most analyst recommendations are buy or equivalent, and the price targets mentioned suggest significant potential upside from current levels, with ranges like $450 up to $557 mentioned.
And in terms of growth numbers?
Consensus estimates project revenue growth around 12.35% for FY26, potentially reaching about $313.23 billion. Intelligent Cloud is expected to continue leading the charge with a projected 22% compound annual growth rate through FY27 and productivity growing around 9.7% annually.
And earnings.
Projected earnings per share growth for FY26 is around 11.7%, with net income potentially growing at a steady 15% annual rate over the next 3 years, according to consensus forecasts.
Okay, but here's where it gets really interesting, I think, and where the analysis highlights a key dynamic, maybe even a tension.
Yeah.
There seems to be this strategic tension between the breakneck pace of their AI innovation and the reality of, well, enterprise adoption capabilities and maybe the speed of regulatory frameworks catching up.
Ah. Right, yes. Infusing AI into absolutely everything is clearly a deliberate and likely very smart move to create that pervasive AI layer, increase the stickiness of their products, and drive new revenue streams, no question.
But moving this fast, could it actually outpace how quickly businesses can realistically integrate and effectively use all these new AI capabilities? And it definitely seems to move faster than governments and regulatory bodies can possibly develop ethical guidelines and legal frameworks for AI.
That's exactly the tension. It creates a potential bottleneck, doesn't it? Either slowing down widespread adoption if companies aren't ready, or potentially triggering regulatory backlash or intervention if concerns about AI ethics, safety, or market power aren't proactively and effectively addressed. The risk factors mentioned in the analysis explicitly call out these concerns about AI misuse, the potential for flawed algorithms, and the danger of biased data creeping in.
So the very strategy driving this immense potential growth also, kind of paradoxically, amplifies their exposure to significant friction points.
Precisely. It's a high-stakes game.
And that leads us directly into understanding the risks more broadly, which the material emphasizes are just crucial for sustained success. It summarizes key risk areas, many drawn directly from their own official filings, like the 10K report.
Right. These include strategic and competitive risks. Just the intense pace of competition, rapid technological evolution changing the game constantly, the battle between ecosystems, pressure on their profit margins from lower-cost alternatives, and the very real risk of their own powerful AI being misused or even weaponized maliciously.
Then there are business evolution risks. These cover the inherent uncertainty of getting a solid return on these massive new investments they're making in AI and hardware, plus the ongoing challenges of integrating huge acquisitions smoothly, like Activision Blizzard, and the potential need down the line to write down the value of assets if some of these big strategic bets don't fully pay off.
And then a huge category, cybersecurity, data privacy, and platform abuse. This is massive for them. There's the constant threat of cyber attacks, including highly sophisticated state-sponsored ones, the risk of finding critical vulnerabilities to their complex systems, and they've had incidents in the past. The increasing sophistication of AI-driven threats making defense harder, just the sheer difficulty of detecting and stopping these attacks across their vast infrastructure.
Plus the critical need to protect the enormous amounts of customer data they handle, the risks of personal data misuse, accidentally or intentionally, and the challenge of preventing abuse of their platforms, think social media aspects, cloud hosting for spreading harmful content, or conducting illegal activities.
And related to that, risks from product defects, especially with complex AI systems potentially introducing ethical problems, having flawed algorithms, or perpetuating biases hidden in the training data.
What about operational risks?
Those are significant too. Things like service outages, taking down critical cloud services for customers, data loss incidents, major disruptions to their cloud infrastructure, problems with hardware components and managing complex global supply chains, and just general software quality defects that could impact users.
And the legal, regulatory, and litigation risks must be enormous at their scale.
Absolutely huge. They face constant scrutiny under competition laws globally, including the EU's Digital Markets Act, specifically targeting large tech platforms. There are risks related to anti-corruption laws, complex international trade regulations, rapidly evolving data privacy laws like GDPR in Europe, which carry heavy fines, the constant threat of lawsuits on various fronts, uncertainty related to government contracts and spending, potential changes in tax laws affecting their bottom line, and increasing pressure and requirements around ESG environmental, social, and governance factors.
Intellectual property risks too, I imagine, protecting their own innovations and avoiding infringing on others.
Yes, a big one. The challenge of protecting their vast portfolio of IP globally, the damaging possibility of source code leaks, and the increasing risk of legal claims from third parties alleging that Microsoft has infringed on their IP, especially concerning the data used to train AI models or the outputs generated by those models. That's a really hot legal area right now.
Yeah.
And then finally, there are broader general risks. Potential damage to their powerful reputation from any misstep. negative impacts from economic downturns affecting customer spending, unforeseen catastrophic events, or geopolitical instability disrupting operations or markets, the physical impacts of climate change on their infrastructure, like data centers, and the ongoing intense challenge attracting and retaining top engineering and research talent in a fiercely competitive market.
What's really striking here, going back to that tension we discussed, is how the analysis points out that Microsoft's aggressive AI and cloud expansion doesn't just create opportunities. It intrinsically increases their exposure across many of these risk categories.
That's the core insight, isn't it? It significantly broadens the potential surface area vulnerable to cybersecurity threats. It massively increases their data privacy responsibilities and potential liabilities because of the sheer volume and sensitivity of data they handle. And it naturally attracts heightened regulatory scrutiny, especially concerning AI ethics, potential bias, and their growing market dominance in these critical new technology areas.
So the very initiatives driving their future growth are also the ones amplifying their exposure to these significant risks.
Exactly. And it's no surprise, then, that Satya Nadella's first stated strategic priority, according to the materials, is fundamentals, with security above all else. It's a clear acknowledgement of this reality. A major failure in any of these key risk areas, cybersecurity, privacy, regulatory compliance, AI ethics, could significantly slow their growth trajectory and severely damage the fundamental trust they rely on to operate at this scale.
Okay, so beyond the core business and the risks involved, the material also touches on their profile as a corporate citizen, their environmental, social, and governance, or ESG, performance. Microsoft has been quite public about its commitments in this area, haven't they?
They have. They have been officially carbon neutral since 2012, which is quite a while now, and they've set some very ambitious future goals. Net zero carbon emissions across their entire value chain by 2030, becoming water positive, meaning they replenish more fresh water than they consume, and achieving zero waste, also by 2030. Their strategy involves massive investments in renewable energy and sustainable operational practices.
And their broader corporate actions are guided by principles like expanding opportunity, earning trust, protecting fundamental rights, and advancing sustainability. How are they viewed externally on this?
Generally very positively, according to the analysis. They've received strong ratings from leading ESG rating agencies, which, the sources note, are increasingly important differentiators in today's market. Things like MSCI giving them top AAA or AA ratings, Sustainalytics rating them as low risk, top scores from ISS, being consistent members of the Dow Jones Sustainability Index, and recognition from groups like GESTI 100 and EcoVadis.
And strong ESG ratings are becoming more than just nice-to-haves, right? They're seen as a competitive advantage.
Increasingly so, for attracting investment, particularly from large institutional funds focused on sustainability, for attracting and retaining top talent, especially younger generations who prioritize working for responsible companies, and even for attracting customers who prefer to buy from businesses aligned with their values. So yes, it's becoming a tangible competitive advantage.
However, the material also mentions some areas of potential concern or criticism, doesn't it?
It does. Areas like the environmental impact of their complex global supply chain and manufacturing operations for hardware like Surface and Xbox, that's always a challenge for companies making physical products. And while Sustainalytics didn't note a significant direct impact for Microsoft specifically at the moment, the broader trend noted across large U.S. companies of potential reductions or shift in focus regarding diversity, equity, and inclusion initiatives is mentioned as a point of criticism in the general landscape they operate within.
And there's an ESG tension here too, isn't there? Similar to the risk tension we discussed earlier, the massive expansion required for their AI and cloud infrastructure building and powering these enormous data centers all over the world requires absolutely considerable amounts of energy and resources.
Exactly. That sheer scale of infrastructure growth poses a direct physical challenge to achieving those ambitious environmental goals they've set, particularly around carbon emissions and water usage.
So how do they manage that?
Well, managing this tension effectively, as the analysis suggests, is going to require significant ongoing innovation. Innovation in areas like sustainable data center design, developing more energy-efficient computing, securing sufficient amounts of renewable energy globally, potentially through direct investments or power purchase agreements, and maintaining really transparent communication about their progress, and importantly, the challenges they face in meeting these goals. It's a huge balancing act.
Okay, so wrapping up this deep dive then. We've journeyed through Microsoft's incredible transformation, looked at their current position as an absolute powerhouse, with intelligent cloud and AI clearly identified now as the central pillars driving their future growth. really embodying that agentic era vision that Nadella has described.
Yeah. Based on this comprehensive analysis, they appear exceptionally well positioned, maybe uniquely positioned, to lead this next massive wave of AI-driven technological change. Their unique advantage really seems to lie in their ability to integrate AI not just as another feature, but deeply across their vast established ecosystem cloud, enterprise software, personal computing, even gaming.
Creating that powerful virtuous cycle for adoption and monetization we talked about.
Exactly. But as the material makes abundantly clear, the intense competition they face from other tech giants and those significant operational, regulatory, and cybersecurity risks we detailed mean this journey requires constant, very skillful management. And given their sheer scale and influence now, they will inevitably remain under close scrutiny from regulators, competitors, and the public.
Absolutely. Their ability to navigate these complex global regulatory environments and perhaps more importantly, demonstrate an unwavering commitment to AI security, ethics, and responsible deployment will be just paramount. Ultimately, as the analysis suggests, their future success will likely depend not just on pure technological superiority, but fundamentally on maintaining societal trust to operate and continue innovating at the scale they are.
Well said. Technology and trust, hand in hand.
And that brings us to a final thought for you, our listener, to consider building on these interesting tensions we've discussed throughout this deep dive. Given the incredible, almost dizzying pace of AI development and Microsoft's absolutely central role in pushing it forward, how does a company of this size and influence truly balance that immense opportunity and the fierce competitive pressure to innovate quickly with the equally critical need for responsible deployment? How do they manage the complex ethical challenges that inevitably arise and simultaneously address the very real, significant environmental impact of their expanding infrastructure needed to power it all? What kinds of trade-offs might they inevitably face in the coming years? And perhaps more importantly, how will the choices they make shape not just their own future, but the future trajectory of technology itself for all of us?